Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
A lease-to-own company and the largest paint manufacturer in the world are two of the top stock picks of the week this week. I'm Tracy Reineck, and I'm joined here at the chairs with Steve Reitmeister. And Steve, I was noticing, because I looked up your lease-to-own company, which is Aaron's, and I was looking at its performance year to date, and they're up 22%, which is better than some of the FANG stocks. Like Google's only up 21%, Ulta, which isn't FANG, but it's high growth.
Sure.
It's only up 16%. So I was surprised by this. So what's going on at this kind of company?
Yeah, we definitely have a turnaround taking place at the company, and in a chart I'm going to show later, you can see where things really went bad and how they've started to come back up since. But you said it's lease to own, and which it certainly is, but one of their strengths is electronic retailing, and that's the group they're in. So that's kind of where this story starts. So everyone's like, electronic retailers, isn't Amazon making them obsolete?
Yeah.
The answer is no. They're fighting back. They're finding a reason to bring people to stores. Even Best Buy is having a nice rebound. And so electronic retailers are actually in the top 1% of the Zacks industry ranks. So we got that as a base going on here for this investment. But also, the growth story here is their finance arm, Progressive. I'm not talking.
I thought it was the insurance company, to be honest.
Not talking about Flow here, okay? Flow's not part of. This is Progressive Finance, right? So what they do for their stores, for the Aaron stores, the in-store financing, but also they have contracts with many other top retailers to put the financing arm in there. So when people want to just walk out of the store without paying anything that day, this is where Progressive comes into play. Tremendous growth story here. So the combination of the two driving these shares. So also I'm going to point out here is an across-the-board winner for the Zacks ratings. So everyone out there knows, get the Zacks #1 rank in your corner, but not all Zacks ranks are built alike. Okay, so a Zacks rank of 1 that also has all the rest of these good ratings. A value score of A, a growth score of A, a VGM score of A, as we already said, in the top 1% of the Zacks industry rank. So all these additional things putting the odds in our favor of having an outperforming stock. Now, the last thing I'm going to point out here is that we do have a turnaround story taking place here. So, the brick and mortar was the difficult spot, as it has been for a lot of retailers, but they are finding ways to fight back. So if we take a look at the pricing consensus chart, for the first 4 years of this chart, it's kind of a hot mess. There is no trend. They're beating, they're losing, the earnings are going up, earnings are going down, and then it's like off a cliff. You see they have an earnings miss, a big one, and things just get ugly in a hurry and the stock collapses. So you talked about the turnaround and how things are coming back. That's the thing is, corporations just don't let things fall apart and, I guess that's what's going to happen.
We've been beaten.
They have to fight back. So new plans coming into place, a turnaround in earnings, the earnings coming back up, and you can see here the estimates coming back up, and that's what's driving the share price. So given the current earnings picture on the turnaround, I'd say that $50 per share is a very likely target. But with turnarounds, you never know how quickly they can accelerate. If this is even better than expected, which is quite possible, and I've seen expectations of over $3 in earnings per share, 55 and 60 is not that crazy of a share price going into 2018. So that's why I'm selecting Aaron's.
Okay, so it's not too late, obviously, with it up 21%. You're still seeing quite a big upside here.
We're trading just under 40 right now, so 25% for my target, and maybe 50% if they can get everything going correctly.
Okay. My company is Sherwin Williams, which is now the largest paint company in the world, but they just merged with Valspar. I'm sure people kind of seen this in the news because it's been going on for a while. They had to go through Justice Department regulations, and they spun off a few things. But now that merger has actually happened, so you're getting the combination of these two big companies. And most people know Sherwin Williams from the paint.
Yeah, of course.
They have 4,000 paint stores, I think, worldwide now. That was their bread and butter, but Valspar has the coating side. So suddenly they've been able to unite with that, and that is also much bigger internationally. So Sherwin Williams had about 16% international business, but now they're going to have about 24%. And they're also reducing their reliance on their paint, which has been great for them. That's been their moat, but it's going to be down from in the 60s to a little bit under 50%. So they're going to have a 50-50 business. Now, you're going to get the synergies with this one because, they're merging the two companies. So they are going to see some cost savings from that. But the the merger is going to be accretive right from the beginning. And, we get the Zacks rank number one because the estimates are going up. And I put up the estimates here because you can see these big gains, jumping. A lot of it is from the merger because it is going to be accretive right away. But Sherwin Williams as a standalone was already growing its business quite healthy because as the housing market stays good, everybody's painting, they were already seeing growth there. And I put up the chart here that shows kind of what Sherwin Williams was doing before the merger, and now you can see they've had this great growth. Just about every year. It's an old mainline company that's been around over 100 years, and now you see the spike up. It's kind of a fake number one in a way, I kind of call it, because they are getting the spike up due to the merger.
Yeah.
But it's also giving fuel to the stock. You can see it's trading at these new highs. It's been real hot. I was kind of looking for a way to get into this stock at some point, and I missed those two downturns in 2015, 2016. I thought it might go lower for my own personal portfolio, but then it didn't, and now it's at these new highs. It's trading around 23 times, so not super cheap here. But I like the growth story and where they're going in. And now with Valspar, they have a bigger presence in China and countries like Australia. Sherwin Williams will be able to get into those markets. So I put up like what my price target might be here is, depending on what everything happens with the acquisition, because you never know. They talk the big talk always. But if things go right, we could see a price target I like around 400 if they actually get all the synergies they're supposed to get. They're actually, the paints is the top industry ranked too, top 2%. But I was looking at it, there's only like 3 or 4 companies in there. It's small industry, but again, with the global economy picking up, the auto industry is still fairly solid because that's the coating side. I kind of like these old mainline companies.
Yeah, going back to that chart here, this is what you want to see on a long-term holding. It's the year-over-year earnings growth. It's the consistency of things going in the right direction, and you don't get too worried about exactly where you grab it because you can see at each juncture it will find a way to go higher because the management team's on top of things that keep driving the earnings higher. So I see the appeal in this one.
It's up 31% year to date, so it's been pretty hot because of the merger. But like I said, I still like it going forward here if you're looking for one of these older, as you said, kind of stable companies.
Yeah, absolutely.
So these are kind of interesting picks here. You wouldn't think like, the paint company and lease-to-own, but
well, everyone's concentrated on all the sex appeal of the fangs again, and they get more and more overpriced. It's these kind of companies that really offer the more attractive returns because they're not being as closely attended to. So so hey, I'm boring but profitable. I'm fine with that.
Me too. You can join us next week for some more top stock picks of the week. And as always, be sure to check out everything on Zacks.com because we have a list of our Zacks number one ranks you can check out over there. And I'll see you again next time.